All right. Well, I appreciate everybody joining us today. I'm sure there's plenty going on around the state right now, so appreciate you taking the time to join us. I do want to start out. I know there's been a lot of talk in the popular press about what's going on in the general economy. I do want to spend a little bit of time on that. I think there's some challenges that are coming down the pipe, and it obviously has some implications when we look at the producers in rural communities that we end up serving. I do want to talk a little bit about drought. It is one of those ones where, depending on where you are, it affected different parts of the state very differently. The unfortunate component there is when we look across a big chunk of our production region for corn and soybeans, we haven't seen that drought creep in a lot of places. There's some planting issues at the start of the season that potentially adversely affected yields, but overall, lack of moisture has not been an issue for a big chunk of the Corn Belt. I want to touch real quick on supply and demand numbers because I think that's going to be one thing that's going to be important when we consider how we market this year's crop. It's one of those ones where when we look at where we are from a supply and demand standpoint, it is really difficult to paint a picture where we see dramatic price increases for our principal row crops in Tennessee over the next few months. I'm not saying it's not impossible, but I think what it does is it creates probably a bit of a ceiling that's going to be tough to push through. I guess one positive is I think we are approaching a bottom on the futures market for some of our commodities. I know it's lower than a lot of people expected it to end up going, but I do think that there's some supply and demand reasons for that. And then I'll close with just talking a little bit about where prices are going. I did want to talk about the general economy, and so I threw this slide together for another presentation, but I thought I'd share it with this group as well. What I put together here is can be broken down into a few different sections. The first one is just kind of some basic economic indicators at the top, then a little bit on interest rates, and then we look into labor force, the stock market, and then some home sales and personal consumption expenditures and loan delinquency rates. And so what I attempted to do here is just kind of color code it. And so I know there's a lot of numbers on here, but the general idea behind here is if we have a green box under the previous reporting period or the previous year, that means that the actual current measure has improved or is positive. If it is red, it means that it's actually declined relative to the previous year, the previous reporting period. And you can see in the one column it indicates when it was last reported. Some of these are quarterly measures, some of these are monthly, some of these are actually daily from the futures market. The other one that's important to point out on here is there are some indicators here that are somewhat subjective, and I'll use the US dollar index as an example. Obviously, a strong US dollar provides some headwinds for us exporting stuff, but it can actually be a benefit when we're importing things like fertilizer that are brought in from other parts of the world. And so there is some subjectivity as to whether these measures are positive or negative. But what I want to get is kind of an overview of the trends. Obviously, when you look at the bottom of this graph, where you have credit card delinquency rates, auto loan delinquency rates, and mortgage delinquency rates, all three of those measures are up compared to last year. The housing market, in terms of existing home sales, is down compared to last year as well. When we look at the stock market, I'm sure anybody that's followed the news the last week or so has seen the tremendous declines. It is important to point out we still are higher than where we were a year ago. But again, there are some concerns in terms of general economic health that I think can affect agriculture and the prices that we face. Obviously, inflation's always been a hot topic for the last couple of years. I think we've started to see it getting closer to that 2%. We're still above the current measure at 3%. But I think one of the things that we are very likely to end up seeing as we get into September and into the fourth quarter of 2024 is that we will see interest rates come down a little bit. And when I say a little bit, I'm not expecting a huge drop, but a quarter to a half a percentage point, I think is reasonable in September, and then there might be one more additional decline as we enter the fourth quarter. So somewhere between a quarter, maybe up to three quarters of a percent before the end of the year. Unless things really start showing weakness, we might see a little bit higher. But we always have to remember that when we're looking at a lot of these indicators, they are backward looking, right? So when we're looking at economic data, it's not a forecast, it is looking back at what's happened in the past. And so when we're thinking about how that affects what decisions are made going forward, it's important to realize that all of these are backward looking measures. And so I did want to throw this up. I'm not going to steal Andrew's thunder on the cattle side of things, but it's important to realize where we are in terms of commodities and inputs. So what this little chart here shows is it's just straight futures. It's not cash prices. So you obviously have to account for basis in your individual region. But it shows the tremendous decline that we've seen year over year in terms of futures market prices at this time across our primary row crop commodities, 20% down across the board. Even month over month, we're close to that 5 to 10% across commodities. I'll talk a little bit about profitability in a second here. When we look at the cattle markets, again, we've seen some softness recently. The other one that I do want to point out is when we look at the input, so the bottom third of this chart, it gives you an indication of how we've seen pretty substantial declines in some of our inputs as well. Maybe definitely not enough to offset some of the price declines. But when we look at natural gas being down 29% year over year, 17% in the last month, part of that is due to some of the perceived economic weakness in the general economy. When we have fertilizer prices down 12 to 15% year over year, that is I guess a benefit, having some reductions on the input cost. But unfortunately, when we made our purchase decisions, some of those inputs were still at elevated levels. And so again, there are some positive trends in terms of the cost structure, but on the revenue side, things are incredibly challenging right now. When we look at ag and drought, I didn't want to show the big map as the centerpiece. What I wanted to actually show was, yes, we've had some dryness, particularly in the southern, middle, and eastern portion of Tennessee. But when we look at it from a national standpoint, when you look at the commodities that we produce in Tennessee, we are at very low levels of drought across the production region. I'll use corn and soybeans. Last year at this time, we were at 57% of production and 51% of production in drought. This year, we're at 5%. And so again, this is going to filter into kind of our discussion of where supply is at and some of the challenges that we're going to face this winter. When we look at corn supply, one of the big ones that I'm going to be paying a lot of attention to as we enter August and September is what that national average yield is. USDA currently has it 181 bushels per acre. There's a lot of speculation that's going to be revised up because of some of the beneficial growing conditions across a big chunk of the Corn Belt. I've heard numbers up in that 184 to 185 range. That would put a lot of continued pressure on supplies. When we look at where our supplies and stocks are, they are going to keep a pretty heavy lid on where prices can move in terms of up. When we look at those production numbers, again, there's going to be some regional differences in production, but overall in the U.S., our production numbers are going to be very, very high. When we look at export competition, I think that's one that's going to be incredibly important to put a floor in on prices. We're going to have to be competitive on the global market with countries like Ukraine, Brazil, and Argentina. But where we are in terms of a stocks to use ratio, I think we are going to end up seeing continued softening of that season average price as we go through. But I do think that the futures market will start to move more sideways. When we look at soybeans, we're likely to have a record yield nationally for soybeans. So again, we're going to have strong supplies, which is going to keep a lid on prices. One of the big challenges that I see is if you look at the foreign stocks number this year, projected for this year compared to last year, it's a 500 million bushel increase. So it's not just the U.S. that is anticipated to have a lot of soybeans. When we look at Brazil and Argentina, I think they're anticipated to have pretty strong stocks. I mean, one of the challenges that we run into this time of year, And I'm not advocating for low prices by any stretch of the imagination, but lower prices can actually potentially reduce the number of acres that are planted down in South America. But right now, it's not forecast to end up having, but the lower prices go, the more financial or lack of financial incentive there is to increase their plantings down in the southern hemisphere as we enter September, October, and November. I do want to just quickly talk about cotton. I know most people on here don't have a strong cotton portfolio in their county, but cotton is probably actually one of the weaker commodities right now in terms of prices. When you're sub 70 cents, you're well below the cost of production on cotton, and we've got burdensome supplies and a lack of global demand, which is really dictating where the cotton market is at this time. When we look at profitability, for those of you that read the monthly WASDE summary that we put out, you'll be familiar with this table. I've done a few adjustments since the July report, but when we look at this across average yields, we'll get some better yield data for Tennessee in the next couple of weeks here from USDA. They'll do some survey-based stuff. But if you look at what the estimated break even, that's that bottom line, we're looking at 78 cents for cotton, 11.26 for beans, 4.61 for corn. Obviously, there's tremendous variability in those break-even estimates, but we kind of use averages for this and then estimated cost of production. Based on where we are in the market, we are way below what the break-even price is for a lot of our producers, and that's going to result in some additional financial stress as we end up going through this harvest and winter season. When we look at cotton futures, for example, right now we're around 67 cents, but there's really not much of an increase as you look at some of the deferred contracts out to March and May. Even anything kind of below that 75%, I don't think most producers are gonna find attractive at all. They'd like to see it start with an 8. I just don't see anything in the data right now that's going to indicate that we're going to get cotton prices with an 8, even in the first quarter of 2025. So there's going to be some challenges embedded in there. When we look at corn, this is the September futures contract at 387 a bushel. When we look at that corn futures prices, there is actually some higher prices as we look further out. I'm going to talk a little bit about that. But where we are in terms of harvest prices, I think one of the big challenges that we're going to have is selling at harvest is going to be a very challenging financial endeavor, trying to get above $4 on the futures contract. And so when we look at this, I wanted to take a look at what the spread was between futures contracts as we move into the winter and spring of next year. And so the way to end up reading this table is to look at the contract, the current futures price, and looking at what the spread is. So for obviously from December to September, there's a $17 spread between those contracts. And then what I did was I calculated an estimated interest cost because we do have elevated interest rates. So an interest rate of 8%, the monthly interest cost to carry a bushel of corn at current prices is 2.6 cents per bushel per month. And so that's where we get that interest cost of 8 cents. And so what you can look at is the spread minus the interest cost. And what you end up seeing is we can get out to that March, May at 24 and 19 cents a bushel. This doesn't account for basis. So, I mean, I think there's a positive component there of carrying it through the harvest season as well. But just looking at the futures market, you can make the argument that storing commodities into 2025, potentially locking in a futures price now, and then just relying on basis can be a positive move for those that have access to storage. When we look at kind of setting our price expectations, I've shown this in some of our meetings. This is the nominal nearby corn futures price. And if you look at the entire time period going all the way back to 1980, the average is 295. This really doesn't tell us anything important. I'd show this just because this is the actual numbers for those of you that follow the futures. What I'm more interested in is when you adjust it for inflation, what that ends up looking like in terms of a reasonable price range. And so when we look at adjusting it, what we end up doing is we look at it in today's dollar. So I use June 2024 as the baseline and adjusted past prices for inflation. And what you actually get is a pretty consistent low in the nearby futures market, somewhere around that 360 to 370 range. And then you get an average of 544. And so since we are in a low price environment, I don't think we're necessarily going to get above that 50th percentile. Um, but what I do think is it does give you an expectation of where we are in terms of the bottom of the market and the potential for improvement. So when we think about how we compare our current market to past markets, what we want to end up looking at are those periods of low prices. And so when we look back um, in the early 2013, 2014 out to 2020, I think you got some comparable data here. You got some comparable data when you go back to the early 2000s, late 1990s in terms of what price activity is. And so the reason why I show this is when we're trying to formulate our price expectations, your trading behavior and how you market your crop in periods of high prices and high volatility, like we just exited, is very different than what you would end up doing when we have lower prices and potentially lower volatility as we end up moving through the marketing year. When we look at soybeans, again, we've continued to drop down to around 10, 11 on November soybeans when I ended up pulling this. What we do end up seeing in terms of a difference between corn and soybean markets is we do see a very different picture when we look at the spread minus the interest cost of carrying that commodity into 2025. And so when we look at this, it has 8% interest. Again, the monthly interest cost on soybeans is estimated at 6.7 cents per bushel per month. It doesn't include basis. But what you'll notice is there's not a strong incentive when you're just considering the futures market to end up having beans in storage relative to where we were with corn. And so again, I think that's a dynamic that is worth exploring in terms of what we're going to end up looking at storing relative to our capacity. When we look at 20-year soybean nearby futures, again, I think it does paint a picture of where we can potentially end up seeing the market heading. If we look back to that 2013 or 2014 range up to 2020, what you see again is that lower volatility, lower price environment where we really have to take advantage of opportunities when we see price spikes. Because when we look at this from a supply and demand standpoint and from a chart standpoint, there's a lot of evidence right now that we are going to be in a lower price environment as we move into 2025 and potentially even 2026. Now, weather in a drought in different parts of the world or the US can dramatically swing prices for sure. But where we sit right now, the data is not supportive of elevated prices when you look at corn and soybeans and cotton for sure. So we look at in summary, I think we're getting close to that price floor. I'm hopeful that we'll be able to hold that 375 area with corn and then see gradual price improvements back up to the $4 mark as we end up going through the end of 2024 on the future side. Soybeans, again, one of the things that I will caution a little bit, and it'll be reflected in my price expectations on the next slide, is that it is more important what happens down in South America as we go from September until January. And so there is the potential, if South America does have a production disruption, to see greater movements in soybeans than corn as we move forward. But again, I think there's a lot of evidence to say that we're going to stay in a lower price environment, so maybe gradual improvements as we enter the new year, but I don't see anything dramatic without some significant event happening. So again, managing our expectations is going to be one of the challenges. Basis is going to be a real interesting one. If you move east to west, you're going to see very different basis offerings, and a lot of it is driven by what me and Andrew were talking about earlier, particularly in corn. When you look at the challenges we've had in the middle and east component, We'd anticipate relative to normal that our basis offerings would be elevated just because of the reduction in production. When you go up to the Northwest, where some of the growing conditions were a little bit better, I think that basis is going to be potentially a little bit depressed. So that's going to be a real challenge as we move across the state. Now, there's only so far basis can really move. Otherwise, we'll see logistically commodities moving across regions in greater quantities, right? So that is something to be aware of. But I think there are potential, depending on what part of the state you are in, to look for some beneficial basis arrangements there. I think profitability is going to be real challenging this winter. It worries me a fair amount that we will see some additional financial hardships. And anytime we see that, yes, there's some opportunities embedded in there, but it also fosters greater consolidation across the row crop sector. When we look at those that have more financial resources, there will be some opportunities for those that do have more resource to end up dealing with this. One of the ones that I was at a conference recently, and I got talking with some of the people from Washington about the farm bill. There is a very low likelihood that we will have a farm bill in 2024, and I really am not super optimistic about early 2025 as well. I think obviously, given the political challenges that we do have, I think that's going to be problematic. One thing that did kind of come up though in our discussions was based on where we are in terms of commodity prices relative to cost of production, was the potential for ad hoc payments. I don't think that it's wise to plan on receiving ad hoc payments, but it is something that's on people's radar, because even if we did pass a farm bill early 2025, it's very likely that none of the support programs or elevated reference prices, to use one example, would kick in until 2027. And so there are some pushes, particularly by commodity groups, to end up getting some assistance out based on how low we are relative to what the cost of production for these commodities has been. So just to close with the futures price forecast, as I mentioned, Tennessee is always challenging when we talk about basis because of how it varies so substantially between our 6 distinct row crop regions. But when we look at the futures price, obviously I'm not super optimistic during the harvest interval that we'll see higher prices, but I do think we will, as we move into Q1 2025, see some elevated prices. Again, the one that has a wider price range is that soybean one, and that's just the South American influence. But again, there's a lid on these prices that I think that they can run to. So if we do see some improved prices, I would expect that we would see a fair amount of selling on that. So with that,